Hello and welcome to today's video. I have a question for you today. If I ask you, how much does it cost to keep cash at hand? What is the expense of keeping cash in your bank? What is the expense of keeping cash under your pillow, under your bed, or in your locker, safe, secured, sound? Maybe in a bank locker. What is the cost of keeping it? Is it the locker fees? Is it free? We'll get to this answer a little later, but let me ask you, what is the cost of keeping a car? You would probably have an answer to this. You would certainly do a small calculation and say, okay, fine, this much in fuel, this much into maintenance, and so on and so forth, and this and that. You probably will come up with a figure of somewhere around maybe 10,000, 15,000, whatever it is, depending on how much you use your car and what purpose you use it. A similar scenario, if I ask you how much does it cost to keep a house of your own, probably you will say the same things. You'll probably have a number, a calculation in your mind. You'll chalk out some expenses, maybe electricity bills and this and that, and you'll have a figure. Maybe probably it's a little more than what you derive for your car, but you will certainly have a number. Now, I ask you the same question again. How much does it cost you to keep hard cash with you in your locker, safe, underneath your pillow, in your almirah, in your safe, in your locker at home? Well, probably there isn't any recurring expenses on this, but there is certainly one expense that consistently diminishes your cash value, and that is the inflation. So the appropriate answer to this question would be the cost of inflation in your area is the cost of keeping cash underneath your pillow. So all cash and cash equivalent instruments, they are constantly eroded by inflation because they offer little or no return value in terms of an investment product. And you want it or not, the real value of the cash that you have kept at hand is going to depreciate every year with the rate equivalent to the rate of inflation in your area. It's an invisible thief, isn't it? But should you protect your money from this thief? Well, to be fair, you can take it as it's a kind of tax which everyone has to pay without any or a tax bracket exemption. I said this because I once read a quote from economist Milton Friedman. He said, inflation is taxation without legislation. How true is it, isn't it? Now, all of us have a fair idea of what inflation is. We probably just quote a figure of like 6%, 7%. We hear it from here and there. We get to know something, someone says something, we take that number and we say, okay, fine, we have an inflation of 7% this year. We have an inflation of 8% this year, 9% this year, 5% this year. Are we true? How much? Is it true that we have 7% inflation now, or is it 6.5, or is it 6.8? What is the inflation in your area? Well, there is a website from the government and it's MOPSI. If you just Google it, right, type in MOPSI, you'll find the link to the government site. Go to the inflation tab, hit it, you'll find the inflation figures that the government has published for that month. Well, it's country-wise inflation figures, and if you go through it, if you go through the inflation breakdown numbers, you can get your state-wise and your area-wise inflation figures. So you can definitely check how much it's costing you to keep cash at hand, how much it's costing you in your area to keep cash at hand. If you see the historical figures, you would probably find currently in the past 5-10 years, the inflation figure has somehow varied between 5 to 8% in between this range. So in literal sense, if you keep cash at hand, this is what exactly you're paying for it. Now you might argue about keeping cash at hand for various reasons. You would probably give transactional reasons. You would say, I need cash, I need little cash at hand shortly, for little requirements, daily requirements probably, or maybe for precautionary reasons. If something happens, immediately I need to get access to cash, and someone gets hospitalized or whatever it is. So these are some precautionary reasons or some speculative reasons that you might give for the reasons that you want cash. Why do you want cash? But let me ask you, are you really giving a reason, or are you shunting away yourself from the pain of investigating a new investment opportunity? You're keeping cash at hand thinking that, okay, fine, I'll put this in the new investment opportunity that I would very, very shortly investigate and find out, and you never do it. Are you doing the same? You say it's a rainy day fund. Is it really a rainy day fund? Why aren't you looking at high liquid investment options? Try and generate the equivalent cash flow from the investments that you make. Try and get an income which would subside, which would try and generate an income which would replace your cash requirements in the short term. So your argument is over. Now that you know that the excuses that you have been giving to keep cash at hand is costing you around 7 or 8% annually, the inflation for your area. So now what do you do? How do you shift from keeping cash at hand to shifting it to an investment which would give an equivalent return, which would generate the cash requirements that you have every month? Or at least if not that, how would you shift your cash into investments which would at least prevent the loss that you're incurring every month, the 6 to 7% loss that you're incurring every month? So how do you start investing? Where do you invest? And the most important thing, when do you invest? Now, having realized that keeping cash at hand is costing you dearly, you would definitely want to put all your money right away into investment options, at least to save the expenses or the losses that you're incurring every year. It's a general tendency with every human being that they would quickly want to safeguard their cash so that they do not lose their real value. Do not do it right away. Your approach should be strategically channelize this cash that you have at hand into investments as per your risk appetite and the returns that you expect from that investment. It's never too late to buy into an investment, but what's more important is to choose the right investment option for you. Be it the stock market, be it the metals, commodities, or real estate, cryptocurrencies, or any other asset classes. Now let's look at some facts. Since the COVID-19 till date, there has been stories which said that people have faced the worst time of their life. Life will not be the same again. Life will change forever. Things have changed, the world has changed. Life isn't going to be as easy as it was earlier. Massive quantifiable damages, human tragic stories, companies shutting down, countries going into debt, and so on and so forth and whatnot. We are filled with stories after the pandemic has hit us. Agreed. Definitely. It has changed our life a lot. It's a huge loss to humanity. But ironically, the market dismissed every tragic event that has happened and has rebounded to claim new highs for itself. It has broken its previous high and it has gone higher up, all the way up. So even under tragic times, the market has given us returns which none of us had expected. And the entire world was faced with situations that they never dreamt of in their life. This is what the market has given us. The market, it did fall down, but it came back and conquered a new high, beating its previous high. But here is something for you. If you have been sitting with cash at hand, thinking that, okay, the market has gone down, it's pandemic, it's a difficult scenario, let me ask you this question again. Keeping cash at hand, did it really help you? Or did you miss the bull run that the market has already shown us? Have you missed the boat, really? Have you missed it yet? No, it's never too late. Frankly speaking, you should buy in small quantities and you should start accumulating your investments. Buy in small quantity and in stages. But you might ask, the market is already high, why should I buy now? Well, buying high is not that difficult and it's not a big problem. But the biggest problem is you should avoid the following mistakes. So what are the mistakes? Mistake number one, if you have a very short-term vision for your investments, do not judge your success or your returns based on a couple of months performance or a couple of weeks or days performance. No, at least give a couple of years time to allow you to put things into perspective. That's the minimum requirement in the market. But in return, what you get is really awesome. Mistake number two, fearing an all-time high. Now this is a big fear, I really understand that. Now when the market has gone up, it has already broken the previous high, it's really at the top. Most people would feel, okay fine, the market has topped. This is it, how far will it go from here? The market has already topped. Probably the recession is going to come up next. If I put my money in now, I would lose it. It's a very, very general, very common thinking. and nothing wrong with it. Absolutely nothing wrong with it. But you know what? In contrary, if you're in a momentum, if you're in a momentum market, if the momentum of the market is high, on the higher side, and if you're investing right now, you can hit higher highs from here. You can get into newer highs from this current top. I'll explain the scenario when we'll do the technical analysis classes in the stock market, where I'll give you examples that we get a buy signal when the market is at all-time high. It does happen in a technical analysis scenario. There are situations when the market has topped up completely. It will still give you a buy signal. Mistake number 3, an all or nothing approach. What is this all about? Just now, as we discussed, that when you get some cash at hand, the first intention, the first reaction of every individual human being is to get this money invested into the market, and they do everything at one shot, at one particular level. This is really bad. You should not be doing this. Do not have an all approach into the market. Invest something, maybe 25-30% of your money into the market, and keep the remaining investments for future, and slowly, subtly, very invest a very small amount, maybe 5% every month into the market from there on. This is called the cost averaging method. So what happens is, even if the market goes up, you get to invest a little bit more. If the market falls down, you get to invest a little bit more at lower value. So it averages out your investments over a longer period of time. Putting everything at one go might destroy your wealth, or might bring up a huge crash or maybe wipe off your portfolio by 20-30% in one go. But if you average it out, if you put in little investments in equal intervals, you would have little risk of meeting these dangerous scenarios of market fluctuations. So, am I saying that we are in a momentum phase? Should we invest now? Well, if I refer to a quote from Seeking Alpha, the secular bull market, which started in 2013, is entering its 10th year now. It's into the 9th year, but it's going to enter into the 10th year. And it still has a few more years to go. Should you capitalize on this opportunity? Rhythm Desai, MD, Morgan Stanley, speaks to ET Prime. He says, India may not get a bear market this time. Historically, the previous secular bull market has lasted for 16 years at a stretch. 16 years. The one in 1950 lasted till 1966. The one which came in 1982 lasted till approximately around the year 2000, 2001. So if you were to believe history is a good teacher in the stock market, this secular bull run has just entered, or maybe is just into the 9th year of its run. And we still have at least approximately another 5 to 7 years in our hand before we see a bear run coming in. It would be a shame if we miss it out. Mistake number 4, waiting for a little more correction before I buy it again. So you wait till the market comes down a little more so that you can buy it cheap. Buy it cheap. That has been your idea. That has been your way of thinking. That is a way of thinking for almost every individual. People think that way. They think, why should I buy expensive? I should buy it cheap. You know what? This looks good on paper, but in reality, it doesn't work that way. If buying in the rising market is difficult, let me tell you what, buying in the falling market is even more difficult. Financial channels, newspapers, TV, media, whatever, you think of any information source, they make their living by confusing people, explaining why the market is falling, giving them reasons as to why the market is behaving the way it is behaving right now. They'll give you facts, they'll give you numbers, they'll give so many things, but at the end, they'll come up saying, is this the reason why the market is falling? If they find nothing to cook up, if there isn't any story to cook up, they'll invent something. They'll invent something to scare the people in the market. The market is falling now. This is probably the reason why India is performing the way it's doing right now at this moment. This is why the Sensex has fallen. This is why the Nifty has come down by 10%, 15%. That may not be the correct reason, but They will cook up reasons to scare you. They'll cook up reasons to put the fear in your head. They'll cook up reasons without a genuine fact backing up, saying that this is the reason, this is the exact reason why this has happened. They'll probably say something like, this happened because this happened, probably this happened because that happened, probably that happened because this happened. And because of all these reasons, all these negative events that are happening around us, this is probably the reason why the market is behaving the way it is behaving right now. They'll cook up reasons to scare you. And this is the reason why you never get to the bottom to buy your shares. You will always get hit by these media, these channels, or these outlets who would scare you into believing that the market is going to fall further. And you will hold on to your cash in anticipation that the market is going to come down again. The market is going to come down once again. It's going to come down once again. And you will never get to buy at the very bottom. You will never be able to do that. And certainly, once that happens and the market dips by another 2-3%, you feel, wow, this is good. And then the news changes. The news, they tell you something more scary. And you feel, wow, what they said earlier, it did happen. It did happen and the market fell by another 5%. So what they're saying right now is also true. The market will fall down by a few more percentages, maybe. So let's wait for it to come down a little bit more, and then probably I'll take a stance to buy something into the market. Let's wait till it corrects a little bit more, and then I'll buy it. And this way, you keep waiting forever. The bottom comes, it bounces back, it goes back up, and you miss the bottom, and you think the market is going high, you think the market is going to fall down again, you wait, it goes higher up, and you miss the train. You miss the train in anticipation of the bottom purchase. Mistake number 5. There is a confusion between the real market and the economy. Are they not the same thing? Isn't the market the same, the replica or the copy of the economy, the market economy? No, they are not. What happens in economy will not necessarily reflect in the market. They are completely different. Yes, they have a relation, but not to a point that every aspect or everything that's happening in the economy is going to reflect in the market. Not always. Definitely not always. Why am I saying this? Because the real economy presents the now moment, while the market discounts and presents you what will happen in future. The market discounts everything. It takes into consideration everything that's going to happen and presents you the final value of what's going to happen in future. The real economy consists of small companies, small stores in your local area, in your state, in your locality. The economy consists of small things, small shops, small businesses in your area, small companies that are not even listed into the market. All of these contribute to the economy. But the market mainly consists of the large cap companies. The Sensex is formed from the top 30 companies in India. The Nifty is formed from the top 50 companies in India. So what Sensex or Nifty would represent those large companies in India. But what your economy is going to present to you is going to be the accumulated contribution by all of the accumulated contribution of all of those small companies that are not listed in the market, also including the larger ones. So it's a wide area, whereas market is a very small area. And since we are discussing two different things, one is a wider area that includes small companies and everything that is happening in and around your area. The other represents the large companies in India or in your country. So the consequences that these two fields face, the consequences that an economy would face, would be very much different from the consequences that the market returns would fetch you. So if there is an event, the consequence of the economy facing that event and reacting to it would be very much different to the consequence or to how the market would react to the same event. But as I said, it's definitely not in sync. It's definitely not going to behave equally all the time. But over a longer period of time, if you see, they both move in a particular direction and in the same direction. Mistake number 6. not buying in expensive market at all. If you see the financial statistics, you would see that the market is high 90% of the time. So does it mean that you would hold on to your cash when the market gets into the remaining 10% when it's at its low? This wait can be very long. It's ridiculous. Alternatively, think it this way. If the market is cheap, if the market is falling, why is it falling? It's falling because no one wants to buy it. There is something wrong in the market. No one wants to buy anything. The government intervenes. It reduces the interest rates for people to spend more. It reduces the interest rates for people to take loan. So that people can take in more money and spend more money into the market. The government reduces the interest rate to increase the cash flow into the market. At this time, when the interest rates are low, the future cash flow discounted to the present value is worth much, much more. This should be the time when stocks and bonds should be trading at higher multiples but with a low interest rate. So is the time different? Is it? Or is it just simple mathematics? I leave it on you to decide. See you again. Till then, SG signing off. Goodbye.